Have you ever wondered who uses financial information and why? You might be surprised by how many different people and organizations are interested in the financial information of a company. There are people within the company, like owners, managers, and employees, and those that are external to the company, like investors, banks, suppliers, customers, and even government agencies. And they all have different reasons why they want financial information. Let's talk about it. Owners and managers are interested in financial information because, probably not a surprise, they are responsible for the financial success of the company they manage. And it's easier to manage that when you can track how well the company is doing financially. Managers, for instance, use financial data to establish financial targets, decide what product lines the company should focus on, and develop strategic plans for future years. One important aspect of managing a business is to track key performance indicators, KPIs, because what is measured improves and what is measured and reported on improves exponentially, according to Carl Pearson, an English mathematician. Managers analyze variances between actual and budgeted results and also evaluate how well individual product lines or departments operate. Owners and managers are under constant pressure to reduce costs to meet Wall Street's or other investor expectations, but most importantly, to compete in the industry they operate in. And accountants prepare reports that identify cost drivers, help monitor expenses, and analyze cost of goods sold. Accountants often take on the role of business consultants and help businesses pinpoint where to save money, what prices to charge, what goods to sell, and whether to make or buy products. In short, how to make good business decisions. Many businesses also need to manage their cash very closely, and financial data helps managers and owners figure out if customers are paying on time, if the company can afford new equipment, to ensure that the inventory levels aren't too high, and that there is enough cash to pay the bills and the payroll. From my experience, managers and owners will ask for many more financial reports than they often need or can react on. A good question to ask is, what exactly are you planning to do with this information? And would you be willing to pay the money it costs to produce the report on a regular basis? The answer is typically no. Reports should be actionable, not nice to have kind of information. One company I worked for limited the number of reports that senior leaders would look at and act on to 5 monthly reports. If they wanted another report, one of the other 5 executive reports ought to be discontinued. That's an interesting approach, and it worked for that company. Employees are another group of internal users of financial data. Employees are interested in job stability, and they feel better about their career at the company when the business is profitable and has sufficient cash reserves. Employee bonuses are often tied to achieving financial metrics, and keeping an eye on the monthly or quarterly financial results lets the employees know whether the metrics are being met and bonuses are likely to be paid out. The company's financial information could also show training budgets, how individual departments are performing, and opportunities for growth when, for instance, one or multiple areas of the company are growing faster than others. So financial information can be quite important in terms of career development. Union representatives use financial data during negotiations to assess a company's ability to increase wages or improve benefits. They also look at the wages of executives to highlight that the top leaders are making significantly more money than frontline employees. Unions also evaluate whether pensions are appropriately funded and the company can meet the long-term commitments to the employees, like, for instance, Many companies offered full health insurance benefits to their retirees, only to cut those benefits when the company faced financial difficulties. Some companies even offer employees the ability to buy company stock at a discount. And in that case, employees want to understand the company's financial information and determine whether to buy, hold, or sell. Investors and shareholders are one group of external users who are interested in the company's financial information. Shareholders analyze different ratios such as earnings per share, return on equity, profit margins, and cash flow, as well as revenue growth, new product lines, debt levels, and reinvestment rates. Shareholders focus on either income generation through dividend payouts or growth of the share price. They want to make sure the company is operating effectively and efficiently, and constantly pressure publicly traded companies to meet revenue and profit targets. Many shareholders, especially retirees, invest in publicly traded companies because they pay dividends. For instance, UPS has an annual dividend payout of nearly 7%, and Verizon pays its shareholders 6.7% in dividends. Some JP Morgan ETFs even pay dividends over 10%. These shareholders review the company's dividend policies and how likely it is for these dividend payments to continue before investing their savings. Banks request financial information, often in the form of financial statements from businesses so that they can evaluate credit risk. Basically, the likelihood that the business will repay the loan. It is easier to obtain a business loan, of course, if there's collateral that the business can pledge towards the loan. That can be equipment, a building, and even accounts receivable. The bank also looks at the business's cash flow to understand if the business actually generates enough cash to repay the current obligations as well as the potential bank loan. Past performance can help the bank analyze trends, and future projections help with the analysis of future cash flows and ultimately business success. Suppliers look at credit reports, audited financial statements, and even management disclosures in quarterly and annual reports to gauge whether the company can and will pay for outstanding or future deliveries. They review financials to figure out whether the company should receive favorable credit terms of net 30 days or net 90 days. Suppliers may use financial ratios such as the quick or current ratio to research how liquid, meaning how much cash the business has to pay its current liabilities. In addition, suppliers often review credit reports to see what other suppliers are reporting in terms of payment performance for the company. Customers review financial statements and other financial data before entering into long-term contracts or service agreements. That makes sense, right? You would not want to sign a contract with a company that may not be around in a few years when you purchase equipment that has a service guarantee. Financial strength signals that the company is well run and that the products and services it sells can be relied upon. Customers want to buy from a reliable vendor who is respected in the industry, especially if the customer plans to integrate the product into their manufacturing process or sell it to their customers. Government agencies use a business's financial information as well. If an industry is regulated by a governmental agency, businesses in that industry have to supply financial information to the regulating agency. For example, the Federal Communications Commission receives financial information from radio and television stations. Publicly traded companies are heavily regulated, and the SEC requires the filing of quarterly and annual financial reports as well as audited financial statements. Other government agencies want financial data for purposes of tracking the economic health of the country with, for instance, labor and hiring data. Tax compliance is a very large aspect of why government agencies want financial information from companies. And from a legal perspective, the government wants to identify and prevent threats to national security by understanding the flow of money in the economy. In addition, the government wants to combat financial crimes by fighting illegal activities such as money laundering and to ensure that businesses are not funding illegal activities. Financial information is important to people who are internal to the organization, like owners, managers, and employees, but also to people or organizations that are external to the business, such as investors, banks, suppliers, customers, and government agencies. What they have in common is that they want accurate, reliable, and timely financial information that is often produced by accountants. That is why it's so important that accounting and financial information is accurate, so that those that rely on this information can make informed decisions. This kind of reliance requires robust financial reporting systems, excellent internal controls, and the ethical tone at the top of the business.